Subscribe to LearnCab and hit the bell icon to get notified.
Thank you so much, Rajashri, for the introduction that we are planning to do for next one and a half hours of our session. So, first thing that I would like to tell you is that in today's session, in the last, it's been a series of sessions that we are conducting. And the last session we had discussed security valuation chapter. And in today's session, what we are planning to do is that we're going to go ahead with security valuation, the valuation methodologies and things like that. Plus, possibly I'm going to give you an introduction on portfolio management in this particular revision webinar. Precisely, we have few questions that has been sent out to us by students. So I'm going to specifically handle two of those questions in this particular session. So probably for 1 hour, I'll discuss on how the topic has to be dealt for your studies, both in case of CA and CMA, how these chapters has to be looked into. And then for about 15-20 minutes, I'm going to discuss those questions that has been specifically put out. I'm specifically telling you this is because if you have any sort of questions from the topic of discussions that you have, be it any chapter, okay, so that whatever we've already covered out, those chapter questions can be put out to LearnCab team, and then it will be taken up with me so that I can discuss those questions and answer those specific queries that you have. So that this act as an overall live interactive session that we are generally going to have. Okay, so let me ask you just one more question, just to understand whether you already attended the recorded lectures in the platform for the chapter security valuation and for the chapter portfolio management. Has already covered the recorded videos. Perfect. So for you, most of the things that I'm going to tell now has been already been understood. If you have any specific questions, always make sure that you just put it out on the chat box so that I can take up those conceptual specific questions that you have. So I had already told everyone the approach. So can I understand whether Priyambada is actually you're from CA stream or CMA stream? So even these two particular chapters, even though when we do a webinar, we say that it is for both CA as well as CMA. These two particular chapters, if you take specifically security valuation chapter, there are a lot more number of questions from that particular chapter in CA compared to CMA. But when you take portfolio management, almost equal number of questions comes from portfolio management chapters in CA as well as CMA. So both of them, portfolio becomes like equally important. There are a lot of questions, and in CMA there are specific lineage towards a certain topic that the CMA examiner really likes, so they keep asking those questions. So that is something that we will have to quickly look into. Okay, perfect. So others, I hope they'll keep answering that as in when our discussion goes on. Okay, so let me quickly take topics so that I can start off with. So I'm going to take out what is there for CA final and then start having a discussion. Okay. So all our recorded classes as well goes in line with our institute material, because that's what we wanted to ensure that is being fully covered. Okay, that makes it very important for us to look into. So these are the areas that is being covered in this particular chapter called as security valuation. In the last, if you had missed out the last webinar, you can go ahead and then watch the recorded ones in the portal, which was just discussion on. We had a detailed discussion on security analysis chapter, and we did not get enough time to concentrate on security valuation. That's why I'm taking this particular chapter here. Plus, I have few questions that has been sent out to me from this particular chapter, so which I can actually answer. So I cannot take on the discussion unless I discuss few concepts relating to value. So that is how the entire chapter also goes on. And I'll tell you why we are learning this. So in a lot of cases, the teachers don't tell the students why you're learning certain things. And especially this happens when we are in schools and all that. We learn so many things without even knowing why we are learning those. Especially like, if you look into maths, you would have learned a lot of equations without really not knowing why exactly in this universe this particular equation is being used for. So you should not have this kind of feeling towards SFM. It is one subject that is becoming very prominent in our profession of chartered accountancy. If you take CMA, that also will hold really good. especially in India, considering Indian financial markets getting real growth. See, we are not a matured financial market, okay? Like if you look into US as the benchmark, or Europe as the benchmark, our products and our financial markets are, it's not that complicated, or it does not have so many products or so many instruments to compete with those bigger markets. But it is growing like in a very fast paced manner. So thereby the profession which deals in finance and core finance in terms of investments is going to grow heavily in next coming 5-10 years of time. And one specific area where chartered accountants these days focus on, even I have also pursuing something called as registered valuer course, which is going to be very important for all chartered accountants in practice very soon. So I'll tell you the preamble in which I'm trying to take this discussion on. Valuation is very important, be it be it a financial instrument, like be it that you're valuing a security, or be it you're valuing a business asset for a transaction like merger, acquisitions, etc. There are multiple laws in India which says that the valuation can be done only by a registered valuer. Or if you look into income tax law, you know that there are provisions which says that valuation can only be done by a chartered accountant. So that actually gives us the to ensure that power to ensure that we will have to have enough knowledge in valuation field. So the point in which I'm taking this discussion is that there's a huge avenue for people to become, in finance itself, people to become valuers of financial securities, which means that after you qualify to become a chartered accountant, you have this separate segment wherein you can practice called as valuation. And even there's a separate entity that is being formed out called as IBBI, Insolvency Bankruptcy Board of India, which is actually a separate entity which has a tie-up with Chartered Accountancy Institute as well as Cost Accountancy Institute, wherein these institutes are allowed to issue the certificate called as registered value. Now, why is it very important for us to understand this? Is that there are laws like Companies Act and Income Tax Law, and in the future, a lot more laws are going to say that any valuation that is being taken up in financial instruments has to be done by a chartered accountant or a registered valuer with all the criteria that one needs to have. So one additional benefits that as a practicing CA that you get is that you're allowed to practice as a valuer. Okay, so there are a lot of assignments that's going to come in the future. Reason being, in India, altogether now there are only like hardly 2,000 registered valuers, and there is so many valuation that's going to go around in this country. So 2,000 is a very small number, and as and when the industry grows in, it is very important that we create enough valuers there. So why we are learning this? Because there is huge set of practical exposure that is waiting for you in valuation. Now, because of that reason itself, we can take a very much of a practical approach towards valuation. And valuation is a global concept. It is not like, okay, in India you value like this. Okay, so it's a science. So whatever that we are applying as valuation rules, that is being universal and it is applied across the globe. Thereby, ICA says that you will have to have so many discussion that you need to carry out in this particular chapter so that you get complete clarity on all the concepts of security valuation. So what is the concept of valuation is the first one. Then there is return concept. There's something called as equity risk premium, required rate of return on equity, discount rate. Then there is specific valuation that we need to do for equity shares, preference shares, and debentures. But I don't want to go in this same order because more or less the valuation concepts remains good for all the type of securities that you want to value. Okay, so let me start with a question so that we can take it on from there. I'm going to make a statement. You have to vouch for this and then tell me whether my statement is correct or not. First one is value is equal to price. When I say value, it is equal to price. Am I correct or not? I would recommend you to interact all answers can be on the chat box. So I don't want to assume that you're sleeping. So I'm assuming that you are awake and then listening to me, so that you can just quickly give me an answer on this. Whether this particular statement will hold true. You would have already heard of this, right? When you go and purchase a share, like let's take a share itself for our understanding. When you're going to the market and then purchasing a share, we call it as market price, right? That's the term that we're going to use. Whether market price is same as value. So correctly answered by Rajesh. So your answer is correct. It is not. Value is not the same as price. This is affected by market forces, which means my demand and supply can have huge impact on what is there in the market today. So what is the point in which Reliance is being traded can be completely because a lot of people really wanted to purchase Reliance. That does not really denote the real value of Reliance shares could be at that particular range. Say 2000 rupees per share is the market price of this particular Reliance shares. But that does not mean the value, which means that we have a term that we're going to use called as intrinsic value, or we can call this as real value. So real value need not to be same as price. But there's one fundamental in which the valuation concepts operates. We assume that in the long term, security will move towards its real value. This is the understanding in which all our valuation discussions is based upon. Okay, so in the long term, eventually all the security prices will move towards its real value. So at this point, the price could be different from value. It can be more than value, which we call it as overpriced, or it can be less than value, which we call as it is underpriced. Are you guys with me on this? So the concept is very simple. Value and price are different. Next question I have is, what do you mean by value of an asset? What is value of an asset? Let's try to have a discussion on this so that this concept remains solid in your head. So that any discussion that comes in this particular valuation, this one concept will give you all the answers. Like I was telling you earlier, all these discussions are basically for you to understand what would be the real value of an asset. Especially we are not looking into real value of an plant and machinery. We are not looking into real value of a building, but the concept remains the same. Where what we are looking is that we are looking into financial assets. Okay. So we are looking into what will be the real value of a financial asset. That's what is the discussion that we are going to have as chartered accountants. And this particular computation of real value is an assignment for you. You'll have to compute and then certify. Like we do audits, we'll have to certify as a valuer. So when we are certifying, we should know, right, really what could be the value. So what do you mean by value of an asset? The very basic method in which understanding value of an asset is to take a physical asset. I'm not going to take financial asset. As you know that there are type of assets. There is financial assets, there is physical assets. I'm going to take a physical asset. Let's assume you're considering purchasing a flat. This is your investment decision. You wanted to check whether purchase of this particular flat is a good decision or not. Okay. The reason being, your purchasing of this flat does not have. See, when I'm taking a financial decision in pure financial term, nothing emotional comes into picture. Like say for the fact that you really like a particular flat, you really like an ambience, and you have an emotional connection with a particular stock just because you really like the name, how a particular stock sounds like Marks and Pharma. Oh, this particular stock sounds very nice. Just because of that, you will have an additional value for that particular stock? No, right? So similar to that, whatever you're going to consider based on financial information. So you wanted to check how much will be the real value of a flat when you're purchasing it. Now, the real value of a flat, I'll have a market price for sure, but then I wanted to check my real value is more than this particular market price or not. So you're considering an investment cycle of 5 years. So every asset in the future, it is going to generate cash for you. So the moment you move from accounting to finance, your indicator of your performance will start moving from profit to cash. So what is the reason why you don't analyze anything in finance with profits? You rather use cash. What could be the reason? I know that these questions are actually the intermediate level questions, but I wanted to ensure that you guys are solid with it. So we always consider cash because cash is something that we can really trust on, because profit will have a lot of accounting entries that is going to impact it. So thereby we consider that yes, it will be cash that will give you a better idea whether you're going to really get some benefits in the future or not. So like there are a lot of non-cash charges towards the P&L, like depreciation, amortization. So the real benefits cannot be identified because the accounting can actually give you fluctuation in profits. So we believe in, okay, let's take cash and then see how much is the real value of a particular asset. So when we are talking about value of a flat, again, real value of a flat, we are looking into an investment horizon. Investment will always be time bound. Okay. If it is for a period of infinite number of years, then how we can do it? We will check that slowly. But then let's try to understand if it's for 5 years, definitely this particular asset is going to generate me cash. Okay. This is my future benefits. Okay. Now, what will be the cash that a flat can generate for 5 years? Now, I'm considering to give this flat on rent. So this flat is going to generate me rental income on a monthly basis. Assume that it is going to generate me monthly rent of 50,000 into 12 months, which means it is going to generate an income of 6 lakh, year 1 to year 5. After 5 years, I'm contemplating the decision to sell this particular flat. I'm assuming that when I'm selling after 5 years, this flat is going to be priced at 1 crore. Are you guys with me? Okay. So if this is the information that is available, can I identify what is going to be my real value of this particular asset, or what is going to be the value of this particular asset today? Now, considering all this information, value of an asset today will be nothing but present value of all these future returns. Reason being, you have to just compare it with a decision on investing in a fixed deposit also. So when we are analyzing an investment option, okay, when we are analyzing an investment option, we are saying that, okay, I wanted to create 5,000 rupees per month, which means that in a year, I want 60,000 rupees. And at the end of 5th year, I wanted to get back my capital of, say, whatever I'm going to invest. So how much amount I should invest today will be generally a question which is going to answer the concept of present value, right? We've already learned present value. I'm not going to explain you what is present value. So you have to take these cash flows into today's value, then that will be the real value of this particular flat. The reason being, this particular asset is going to generate your future return. What will be the present value of this particular return? Because you cannot always add it up and say that in the future I'm going to have this much of amount. So whenever we say value, we are talking about value today, and that value is determined as a result of what is going to be the income it is going to generate. Now again, the income is denoted always in finance as cash. How much cash it is going to generate in the future? Are you guys understanding? So you will have two cash flows that is going to come, which is an yearly cash flow, which is the rental income, and also you have a cash flow which is going to come at the end of 5th year, which is when I'm selling the flat. Now for you to bring these amount into present value, you need something called as discount rate, right? Now what is the discount rate? Discount rate depends upon what is that you require as a rate of return for you. Say it is almost like the expectation of the investor. So how much is the required return for you to take this particular decision of investing in a flat? So if you are expecting 10% return over the period, then you will take a discount rate of 10%, and using this particular discount rate of 10%, you will discount this particular cash flows, and you will discount this particular cash flow at the end of the 5th year. So both of these particular cash flows, when you discount, you will get, let's assume that we have got the discounted value as say 90 lakhs. This is what you got as the value in this particular decision. Now if this is the case, what you have to do is that you will have to compare this particular 90 lakhs value, that is the price in which this flat is available in the market. If this particular flat is available in the market for a price which is less than 90 lakhs, then we will say that it is underpriced. It is always better for you to take this particular flat because you're going to generate a return of more than 10%. If you're going to buy this particular flat for an amount which is more than 90 lakhs, your return is going to be less than 10%. Are you guys understanding this particular concept? So what is value is a very simple concept. Value today is nothing but present value of future cash flows. And how future cash flows are going to be? It is going to be two types. One is the annual cash flows. What is the present value of this annual cash flows, and what is the present value of your cash flow at the end of the period? In our decision, it was what is the sale value of this particular flat at the end of the year. So that is going to be called as terminal cash flow. Discounted at required rate of return. So this is how generally a valuation concept is being explained to you. Okay, so very simple concept. Whatever, now whenever you change the asset, you change these cash flows, that's all. Okay, let's try to have that particular discussion. If I'm computing value of a flat as an investment decision, I'll take what is the present value of future cash flows. Annual cash flow would be rental income, terminal cash flow would be what the sale of asset, and I'll discount it what is the required rate of return of the investor. Now what if it's an equity share? Okay, let's try to understand it. Equity share. What will be the value of equity share? Same concept remains the same across any financial assets that you take or any assets that you take. Value of equity share today is nothing but present value of future cash flows. Now what will be the annual cash flow that we are talking about? When it is an equity share, what is the cash flow that an investor gets? What will be the annual cash flow that we have, or whatever may be the cash flow till you sell it off? What is that you will get when you're investing in a share? If it's an equity share, generally it is going to be dividend. And what do you mean by terminal cash flow? What is the expected value of shares at the end of your investment cycle? Okay, say I'm going to invest it for 5 years. So what is going to be the expected share value at the end of 5 years? Okay, this is how you will compute it. Okay, if it's this is one model. Okay, if it's instead of equity shares, let's assume that this happened to be preference shares. The cash flow is going to be preference dividend, and what is the terminal value of this particular preference shares? If it is debenture, same, it is going to be called as coupons, and what will be the terminal value of this particular debenture. So in case of preference shares and debentures, we almost know that, okay, so at the end of the period, more or less this is going to be either to be redeemed at a discount or coupon. But when equity shares are being issued, there is a general understanding that in equity shares, generally when you are issuing in when you are investing in equity share, you don't have something called as redemption. So this could be invested forever also. Okay, there is an idea that we have that this particular equity shares investment will be forever. So in such cases, how do you substantiate your valuation concept? That's why you have multiple methods in valuation. Okay. So that is the first set of discussion that you have in your textbook. If you analyze how the question pattern has been over the period of time, you can understand that in a lot of examination that has happened very recently, the number of questions that we are getting on valuation has increased, and they're not asking the typical type of questions. Now these questions are more concept oriented, and each of these methods you will have to thereby you will have to have proper understanding on. Okay, now let me try to explain you that. So you can see here there are multiple methods that you have for equity valuation. Let me give you understanding on what are the methods that we have. Okay, so all these methods are generally based on what cash flow you are considering. Yeah. So whatever method that you're choosing, it will change based on what cash flow that you are considering for this particular valuation purpose. Say you have models like constant dividend model. So when you're considering dividend as the cash flow, we call this as constant dividend model. I can either consider dividend as the cash flow. There are cases where we consider EBIT, or we can say that income or profit as cash flow, as your income in the future, the whatever cash flow that you're going to discount, or you have something called as free cash flow model. So you have multiple models in which we compute, and what is that we are going to discount only changes, which means that whatever is the annual cash flow that you're going to take, if it changes, then we will have to accordingly replace that particular cash flow into your model. That's it. So constant dividend model, you have dividend growth model. These are all very simple understanding. Okay, in dividend growth model itself, you have something called as H model. You have 2-period growth model. You have 3-period growth model. All these kind of models are there, which all function on the same concept. Then you have so all of these. Okay, we can call it as H model. Okay, so you have constant dividend, you have dividend growth model, you have H model. Here itself you have single period, you have 2-period, 3-period. All these kind of growth models are available in your chapters, and we have already put out all the detailed videos that you can watch out. But let me try to consolidate this, give you a summary on how all of these models can be learned together. Apart from this, you have a lot more number of There are multiple other models, like you have something called as relative valuation. You have valuation based on customer. Okay, a lot of new startups. You have multiple startup valuation model like Berker's models. Then there is a bunch of new models that is being coming out, but all of those models are not being discussed in say a final. But what I'm trying to tell you is that when you look into practically, there are multiple other methods in which valuation is being done as well. Generally, they test on dividend growth model, which can be tested either with dividends or it can be tested with free cash flows. Now, let me first start off with one simple question on dividend model. First, we will look into what if there is constant dividend, what if there is a dividend that is going to be constant as well as it is growing. I otherwise also call this as Gordon's growth model, which is generally tested a lot. Then we will try to understand why sometimes we choose free cash flows over dividend, and what could be the reason why we have to do it in our valuation. Okay. In fancies, we call constant dividend as the model name. Let me take an example. A vanilla example, very simple one. ABC Limited is a company which gives you constant dividend of rupees 10 per share annually, and at the end of second year, value of share expected at rupees 50. The required rate of return of the investor, assume 10%. If that's the case, what is the value of ABC share today? Like I told you, only thing that you'll have to do is to compute the present value of this particular share. So computation is very simple. What is the year? 1, 2. What is the cash flow? What is the present value factor? What is the discounted cash flow? Here the cash flow happened to be dividend and terminal value. So first year I'm going to get 10. What is my present value factor? It will be 1 divided by 1.1, which we already know, 909. 0.909 would be the one. So it will be 9.09. Then second year, I'm going to have two cash flows. One is dividend, which is 10 plus 50 rupees, which is the terminal value. At the second year, I need to use the second year discounting factor, present value factor, which is 1 divided by 1.10 to the power 2. 0.857, if I'm not wrong. So it's 826. Okay. So if that's the case, multiply that with 60. That is 49.59 plus 9.09. 58.68. This would be the value of this particular share today. Okay, so this is how you generally compute a vanilla case of value. Okay, so you have to just find out how much is the future value and then discount it. That's it. Next is, what if this particular ABC shares you're holding forever? I don't have an infinity. I don't have an terminal value. I'm holding it till infinity. If that's the case, you will compute the present value using the method called as perpetuity. So what is a perpetuity? It's almost like this. Say I wanted 10,000 rupees annual return forever. So how much money I should invest today? If I want 10,000 rupees annual return, and that is going to be 10%. So I want 10,000 rupees and my expected return is 10%. So how much, and I want this 10,000 forever. So how much should I invest today? So I should invest, how do I compute that particular answer? If I want 10,000 and I'm expecting 10% return, so what is the interest you want? What is the rate? Divided with the rate, or I. What is the cash flow that you require divided by I? Whatever may be the formula that you wanted to create it as. 10,000 you want and 10% is what you're expecting. So it will be 1 lakh that you have to invest. So if you have 10% return promised, and if you invest 1 lakh, every year you're going to get 10,000 forever. So similarly, if you're investing in ABC and you're holding it till infinity, then of course you're going to have, say if you want 10, if ABC is going to give you 10 rupees as dividend forever, and 10% is what you are going to get, then 100 rupees is what you will be paying as the value today. So this is how you will compute the answer for infinity. Okay, but the assumption that we have in this particular model called as constant dividend is absurd. So do you think that you will be interested in investing in a company which is going to give you the same set of dividend forever? Okay, it's giving you constant dividends. Then I don't think people will be interested in investing in that. So thereby, what you have to do is that you will have to go ahead and then assume that this dividend is going to grow over the period of time. So that's where you have something called as dividend growth model that comes in. This is a very popular model that we have, and very popular examination question as well. Okay, so also we call this as Gordon's growth model. So in dividend decisions that you would have learned in your intermediate or your executive level, you would have learned about something called as Gordon's growth model, which is also being utilized in CAPM in computing cost of in cost of capital chapter. You would have learned about this particular model already. Okay, let's try to understand this anyway. In Gordon's growth model, we are saying that there will be dividend, but dividend is also going to grow. So, but the growth is going to be, growth can be constant, the growth can be different. Like, you can have a period for an investment wherein initially it will grow very high. After that, it is going to saturate for some time. It is not going to grow at the same rate forever. Then after that, it is going to be stable growth. Okay. Then at some point it could decline and then continue for some time. So this is how. So you can have a high growth period. You will have a transition growth period, and you will have stable growth period. So if you can have 2 growth periods. You can have 3 growth periods. So depending upon that, you will have to find out how you have to change your understanding. Say one formula that you should not forget at all is your dividend growth model. Value of share in dividend growth model is going to be whatever is your cash flow for year 1 divided by what's your discount rate, which is, if it is discount rate is generally taken as cost of equity. So there are multiple reasons why we take cost of equity as your discount rate, which you will have to go and watch our lectures to understand why we take it as cost of equity, and minus growth. Okay, this will actually give you an understanding on how to calculate value if there is growth also involved in this particular dividend or whatever cash flow. So if you're using dividend, the dividend growth model is going to be redrafted as what is going to be your dividend for year 1 divided by KE minus what's your long-term growth. Okay, this is how you will do it. Okay, so if you're expecting there is going to be a dividend of 10 rupees, 10 constant dividend with a growth rate of 5% forever. So the dividend is going to grow at 5%, and your expected or your required rate of return is 10%. If that's the case, then how much will be the value today? So can you assume that the value would be same as 100? No, the value cannot be 100, because if somebody is giving you only 10 rupees as dividend, you're assuming the value to be 100. So if somebody is going to give you 10 rupees with an annual growth of 5%, then you should be ideally ready to pay more than 100 rupees for this particular share. So thereby the formula would be like this: your expected dividend is 10, then your KE is 10% minus 5% is your growth, KE minus G, which is going to be 10 divided by 5% KE minus G. So which is going to be 200. If your company is giving you only 10 rupees constant dividend, your price is with your 10% return you're expecting, you're ready to pay 100. But if it's going to grow over the period at 5% still infinity, then you're ready to pay 200. Are you guys understanding this? Okay. Now this is how you do the computation in case of dividend growth model. Okay. Now the growth need not to be constant. The growth can actually fluctuate. Now let's assume a computation in that manner as well. So I'm telling you, these methodologies remains the same if you are changing your cash flow from dividend to free cash flow as well. Okay. So thereby you need not really worry about what cash flow is being given in the question, but the concept has to be same. So when you read out a question, you should be able to identify. Okay, we have solved a lot of questions in this particular chapter in the recorded video. So you should be able to figure out what model is being tested. Is it constant dividend, or is it dividend growth, or is it having multiple growth? Okay. So if it is, say for example, I'm going to have few years, year 1, 2, 3, 4, and 5. My dividend is 10%, rupees 10 here, but initially it is going to grow really high. It is going to be 20% growth, which is going to make it 12. Again, it is going to grow 20%, which is going to be 2.4. That means 14.4. Again, it is going to grow 20%. That makes it 2.88 will be added, which means 17.28. But from this year onwards, it is going to have a stable growth of 5%. If this is the scenario that we have, okay, see, I'm going on with an assumption that you guys have some idea on valuation. You guys are watching. If you have not finished watching the entire videos, that's still fine. You try to be with me, try to get as much concept as possible inside your head. That will be more than sufficient. Then you can always go back and then read it. And then if you have any doubts, you are always welcome to reach out to us. Okay. You can connect to me personally also and then ask me the doubts, like, this particular question I would like to get your opinion on. Let's try to understand this. So here in the earlier question, I was saying that the dividend is going to grow at constant growth rate. Now I'm having a variable growth rate, which means the first 4 years, the growth happened to be 20%. Then the growth happened to be 5%. So how do you compute the present value here? Now I will have a required rate of return, which is my discount rate, which is going to give me my discount rate. I can discount all this, but now I have a stable growth that is going to happen from year 4 onwards. This is a very tricky understanding that you need to have, but without this particular understanding on what I'm going to do next on computing the present value, your whole concept of present value computation is on a stall. Like, you will, unless you understand these concepts inside it, you will find this all little complicated math computation. So it's not like that. You have to approach it in a very phased manner. Now let's try to assume this. Okay, I have an example where there's a company XYZ Limited, which has a dividend expectation of dividend just declared is 17.28, and with growth expected is constant growth. What will be the value of this particular share if required rate of return is 10%? So if you ignore the above example and concentrate only on this particular question, if I am expecting a company is going to be growing at 5% from their dividend, which is already declared, and their discount rate is 10%, then here I can simply use my dividend growth model and then tell that my dividend at the end of year 1 divided by KE minus G will be my value today. Now here, whatever dividend declared at year 0, now I want to understand how much is the dividend that is declared at year 1, which is 17.28 is going to grow again by 5%, which means that it is going to be into 105%, right? Or I can say that this is going to be into 1.05 divided by KE is 10% minus growth is 5%. Let's assume that I got this particular answer as 290. Okay, I'm just assuming, I'm not computing because it takes time. I'm assuming that 290 is what the correct answer I got. Now, this will be the value of a company XYZ if they are giving you the dividend of 17.28 for infinite period of time, right? This will be the with a growth rate of 5%. Now you have to understand that what if there is another company which is going to give you same return, which is 17.28 from year 4 onwards till infinity. If that's the case, at the end of year 4, you have to just think it in two methods. Okay, one method is that if there is a company which is going to give you 17.28 rupees as dividend till infinity, you've already computed that you are ready to pay that particular company 290 rupees. That is the value. But that particular company, if it is going to give you additionally again few more returns, the value of that particular company will be more. Yes or no? If it is only giving you that 17.28 and until infinity, yes, I'm going to have a value of 290. But that there is another company which is giving you additional return, which is 10, 12, 14.4, 17.28, all that, then that company will have some extra value. This is something that we can all agree on. If that's the case, then we have to understand that this particular company will have a value at the end of year 4. See, after I receive 10, 12, 14.4, at the end of year 4, I'm receiving 17.28. Then this particular company is same as this XYZ, right? So after I receive this 10, 12, 14.4 and 17.28 at the end of year 4, and you're trying to sell this particular share, this company will be valued at what value? It will be valued at 290 at the end of year 4. Because when somebody is thinking from year 4 till infinity, he's saying that, okay, now I received 17.28. Till infinity, I'm going to have a growth rate of 5%. Then how much will be the value of that particular share today? That becomes this particular question. So which means that the terminal value at the end of year 4 is going to be 290. Are you understanding? So if I have variable growth, you can actually compute your terminal value, TV terminal value, by using dividend growth model. Okay. So it's a bit tricky, but you have to understand that this particular concept is a very, very core concept in case of valuing your shares or any equity, whatever shares that you're taking for that matter. So then what you have to do, you have to compute what is the discount rate. Then you have to discount all of this into 3, 1 divided by 1.10 power 4. Here also it is also at the end of year 4. So if I discount all of this by using this discount rate, I'll get a present value that will become the value. So there are multiple questions I've done on the recordings on this particular aspects. So it's very important that you understand this. Now let me quickly jump on to giving you an understanding on why we have not gone ahead with dividends always. Why there are concepts wherein they take income as well as free cash flow. Income is not very popular, but free cash flow models are very popular, and they're going to ask questions on that. So when you're studying this particular chapter, please concentrate. If you're a CA student, please concentrate on free cash flow model. It's going to be very important for the examination now. And I have two questions. I have one question which is on free cash flow only. Okay, so I'll specifically answer for that particular student who had asked me that question. Now, why am I not taking dividend as the cash flow? Because when a company is declaring dividend, that does not mean that that is the only profit that is made by that particular company. So whatever amount that is generated by the company and retained in that particular business is also an income that belongs to ultimately to the equity shareholder. So that is the argument that the income model people are making, saying that see, it is not your dividend that is going to be real return. Even whatever profit that is generated is for the equity shareholder. So all that has to be considered. It's just that that is there with the company now. It is not given to the equity shareholder, but it eventually belongs to whom? Equity shareholders. So they say we will take in all these models instead of dividend. Okay, what is your earnings after taxes, EAT, or what is your profit after taxes? That will be the cash flow that we are going to use for computing the value. But when you're taking profits, there is a very high chance that we are going to leave out a lot of revenue, a lot of cash flow, because we are taking a lot of accounting provisioning. Okay, so if a particular company had purchased a huge capital investment in that particular year, there will be huge impact on depreciation, and that the comparison that you will have on the value between two companies will be lost. Say there are two companies which is making same profits, same operating profits, but two of them have two type of different depreciation. The net profit can be different and the value will be different if you're taking your net profit as your cash flow. Are you understanding? So thereby, income approach is not very common. So they said the real addition into the revenue is not your income. It should be rather free cash flow. How much is the cash flow that you are generating? So there are multiple ways in which you can compute free cash flow. Okay, free cash flow is nothing but when you're using free cash flow models, which is very popular in all the practical valuation, we use free cash flow models only. Now, free cash flow models, you're computing what is your operating cash flow, and then you're reducing what is your capital expenditure, and you're reducing you're adding up how much is your net borrowing. Okay, operating cash flow. So we know how to determine cash flow statement. So operating cash flow will be what? Your net profit. You add back depreciation or non-cash charges, depreciation, amortization. You reduce your net working capital. Then you will get how much is the cash generated out of this particular company. Then you say check how much is your capital expenditure. You have to spend that much amount, you have to spend. So that is gone. Plus not fully that is being spent by capital. If there is some loan that you're going to take, so that loan is actually added back to your cash. So how much is the cash generated out of this particular business? Again, there are two concepts that we have called as free cash flow for equity and free cash flow for the firm. So when you're computing free cash flow for the equity, how much is the free cash flow? Look at the term. They've used the term free cash flow, which means there is no hook onto that. That full cash flow, if wanted, can be given out to the shareholders. Free cash flow. So free cash flow for equity means that after you spend out on the returns that you have to give to the debt holders, like banks, the debenture holders, all these people are actually holding debt. Okay, so you have to reduce your interest. Then what is the cash that is left out? Will be considered to be the free cash flow for the equity shareholders. When it is as a firm, sometimes you have to compute value. See, when you're making a decision on selling the entire business, okay, so you'll have to consider how much will be the value of this particular firm, including the value of your equity as well as value of your debt. So in such cases, we will compute something called as free cash flow for the firm, which means that whatever amount of profits that you have, before you even give the interest, that also becomes your cash flow for the firm, because you have now the firm is having two components of finance. One is debt, another one is equity. Okay, this is how the differentiation would be, and depending upon what cash flow, that whether you're taking free cash flow for the firm or free cash flow for the equity, you'll have to correspondingly change your discount rate. If it is free cash flow for the equity, you will have to take KE. If it is free cash flow for the firm, you will have to take KO, or weighted average cost of capital. These concepts have been detailed, discussed. You have to go through the portions and then ask me if you have any doubts on. Okay, so but Mark, consider these as very important. Similarly, you have concepts on bond valuation as well as preference shares. Preference shares not generally taken, but bond valuation, same concepts. You have few additional methods in which you will assess the bond. Bond also is having a value, the same concept, present value of your future cash flow. When it is bond, your future cash flow eventually becomes your interest that you're going to give. Now you're going to, when you're talking about bond valuation, you're computing how much will be the value of a bond for the investor. So if how much you will have to pay for buying a bond of this particular company. Now you will again look into how much is the return that it is going to give. So debenture is going to give you return called as interest. In bond valuation terms, we call it as coupon. How much is the return that you want? Based on that, you will actually do a discounting and you will get what is the value. So how much is your return that you want is generally called as YTM. Okay, yield to maturity is the concept that we're going to call it as. That's the real yield. So interest is not the real yield that you're going to get. It is going to be YTM. And there are a few additional concepts like duration, modified duration, all that is regularly tested because bond market is much, much bigger. A lot of institutional purchases that happens there. So it's a very big market and it's universal. So there are questions that typically ICI and Cost Management Institute, both of them ask a lot of questions on that. So you'll have to have logic-based understanding on all of these concepts. Now, I would like to, this is all I wanted to cover as a revision. And I wanted to tell you that these are the areas that you'll have to focus on. Now, I would like to take the question that has been sent out to me by the team. So this is a question from Srinivas K. So if not, I'll try to answer. Probably he can watch it on the recordings. So if he's not attending, I think LearnCab team, you can actually inform him that the recordings will be available and suggest him to live sessions next time when we are taking it. Okay, let me look into the question. So he had put out two questions. In question number 6 for calculating net borrowings, why depreciation is reduced. Let me look into this question number 6. Okay, so question number 6, I'll quickly tell you what is this question all about. This question is asking you to compute value of the share, and they have given you the profit of the company 290 crores. Equity share capital is 1300 crores. Par value of the shares is 40 each. So which means that you can compute how many outstanding shares are there. So if you know how much is the outstanding shares, if you divide that outstanding shares from profit of the company, you will get what is the earnings per share. So you got what is the earnings per share with you. Okay. Now there's a debt ratio that is 27%. What is the meaning of debt ratio? How much is the capital that is required by the company? 27% of that will be generally taken as a debt from outside. Growth rate of the company for the first 5 years, see, which means that they're actually trying to give you 2-period growth. For the first 5 years, it is 8%, and growth rate for the company for year 6 and onwards is 5%. From there, it's constant growth. Capital expenditure per share is 47. Depreciation per share is 39. Change in working capital is 3.45 per share. Cost of equity happened to be 8.86. Cost of equity is your discount rate. Now, this particular question gives you information on cash flow. So the cash flow, the model that you have to use is a cash flow model, but with 2-period growth. Let's try to understand how much will be the cash flow here. So you know what is earnings per share, profit. From profit, if you add back your depreciation and reduce your working capital, you will get what is the cash flow from operation per share. Plus, if you look into how much will be the capital expenditure per share, so that much amount you will have to spend out. So minus your capital expenditure you can do. Plus, you will have to borrow some money. So his question was, I'll check out the answer so that I can explain him where he has got confused. The solution is here. So what we do is that we compute what is the profit per share, which is 8.923 we have got. We know capital expenditure, we know depreciation, change in working capital, debt ratio. All the information we have written first. We compute what is free cash flow for equity, which is net income plus the equation you can just look into first. net income plus non-cash charges minus capital expenditure minus changes in net working capital plus net borrowings. In this, net income is available, non-cash charges, depreciation is available, capex is available, change in working capital is available. Net borrowings is not directly available. But we know that how much ever is the additional capital that is required, 27% will be funded by debt. So that much debt I am going to add to my cash. How much is the money that is required? See, I have new capital expenditure that is required, which is 47. But already 39 rupees is being allocated to depreciation, which means that that much of profit is being allocated. So in the net, how much money that is required for me is only 47 minus 39. Okay, so you've already created depreciation, 47 is required, but you've already allocated from your depreciation 39, plus you require 3.45, which is 3.45, which is the additional working capital that is required. So you require 47 for the capex, you require 3.45 for increased working capital, but you've already allocated 39 from your depreciation, which means that net additional cash you require for the next year is only 11.45. Okay, this is the concept. This is the type of question Isaiah has done. This is out of this particular 11.45, which is the net amount that you cash you require, 27% is funded through debt. That is how we have computed the net borrowings. That is why we are actually reducing depreciation from that particular case from the cash, additional cash that is required for the next year. Then in question number 1 in bond valuation, how can we compare present value 8% with present value after 6 years 12% to find out the potential loss? Please explain. Okay, so I'll take out that particular question. Okay, Pet Feed PLC has an outstanding a high yield bond with following feature. Face value is 10,000 pound, coupon is 10%, maturity period is 6 years. Special feature, company can extend the life of the bond to 12 years. Presently, the invest rate of the equivalent bond is 8%. If the investor expects the interest will be 8%, 6 years from now on, then how much he should pay for the bond now? So he's assuming that discount rate is going to be 8% from 6 years from now. And if that's the case, how much he should pay for this particular bond now? So presently the invest rate is also 8%, and he's expecting that this 8% is going to hold good for the 6 years period. Then present value of this particular bond will be coupon 10%, which is 1,000, discounted at 8%. You can use actually an annuity, present value of an annuity, because it's going to be the same coupon. And 6 years, if you discount, you will get what is the value. So what is special in this particular case? If the company wants, they can extend it for another 6 more years. Now suppose on the basis of their expectation, he invests in the bond, but the invest rate turns out to be 12% 6 years from now. So which means that if after 6 years, if the company wants to raise another capital, company has to, their incremental borrowing rate will be 12%. So what company will do? They have a running bond which is going to give them 10% coupon. So they are going to go ahead with that particular, continue that existing bond. They will not issue new bond, because if they are issuing new bond, 12% is what they'll have to bet. So what will be the potential loss or gain is the question. So if this particular case, if you're analyzing, say let's assume 6 years is what you're analyzing now. Let's try to look into the answer. So if you look into the valuation for 6 years, the value happened to be $10,923 today. So with this particular understanding, you've gone ahead and then invested in this. Assuming that this 8% is going to continue for another 6 years, which means from year 1 to year 6, the value is going to be year 1 to year 6, 10% coupon rate. And at the end of the year 6, you're going to get $10,000. We will assume the redemption at $10,000 at par value. Then the value today is going to be 10,923 pound. Okay, so in such cases, the company will not continue, because company is going to get 8% is the rate that they're going to get in the future. So they'll rather redeem this particular bond and then issue a new bond with 8%. So you expect your value is expected to be 10,923. But if the interest rate after 6 years happened to be at 12%, then the company would continue this particular bond for another 6 years of time. Okay, so time till maturity is 6 years again. So in such cases, my discount rate is reduced. So at the end of the year, this particular bond is going to be priced at, from 6 years from now, from another 6 years, it will be priced at, it will be discounted for another 6 years for 12 percentage, wherein your coupon is 10 percentage. So your effective rate at value of the bond is going to be, after 6 years, is going to be 9,181. Now we have computed the potential loss as the difference between what is the value of the bond today and what is going to be the value at the end of that particular period. So ideal scenario, your question is correct, right? So your question is perfectly up to the point. You cannot really compare this because these are going to be there on different time period. But the question is very blanket there. What is your potential loss? The potential loss is going to be the difference between these two on present value terms. Okay, that will be the real loss. But they have taken this particular difference. This is the institute answer. They have taken the differences as to give you an understanding on how much is the payoff. So 8% of present value after 6 years and 12% to find out the potential loss. So if your question is why are you comparing the cash flow or value today with the value after 6 years? Yeah, probably your question is correct. If your potential loss, if you wanted to get in present value figures, you have to again discount it for that particular amount. Okay, you can give them an understanding by saying what is the potential loss that will happen, because when you expected it to be at 10,000 at the end of the year, and then you have gone ahead and then invested in it. But what happened is that at the end of the year, it happened to be 12 percentage the interest rate. Then your value has actually been reduced. This is what is the understanding. I hope this would answer his questions. So if anybody has further questions, they can send it out a little bit, like probably 2 days before the session, so that we can solve it out. So if there is no further question, I would like to wind up today's session, and I'll see you all with another session in the coming week.
Subscribe to LearnCab and hit the bell icon to get notified.